Hello and welcome to the Cryptocurrency News channel. Haven't gotten my computer back yet, but it's pretty much like Monday morning, just after midnight. Um, so I will probably get my computer back Monday or Tuesday. So I don't know if I'm going to stream tomorrow. If I can stream tomorrow, I can't really do it from my phone because there's too much trouble and I don't really have the connection from the phone. Anyways, I want to talk a little bit about some news analytics and this weekend's dip. So, Heavy Analytics actually has revealed that it's not Elon Musk or any of these other factors that is really dragging Bitcoin down. It is not actually the spot market, people actually selling Bitcoin, dragging it down. It is the derivatives market, which includes futures, margin trading, not spot contracts, options and stuff like that. That is really what's driving the market down. Now, ever since like futures and derivatives have been introduced, the market I think has actually gotten more volatile. It can go up much faster because of liquidations and long buys, obviously, and can go down very, very fast because of shorts, liquidations, and like short selling, puts and stuff like that. So what options are, I've explained this before, they basically allow you to interact with the asset, whether it's crypto or stocks or something else at hand, without actually owning part of the asset. So it's basically like rich people's way of manipulating the market without really touching the asset itself. I am fully against most derivatives options and stuff like that, especially in crypto, but pretty much every mature market has them. So it's something that we actually need to watch for. Now, the thing about crypto derivatives is that like with exchanges like BitMEX, they're actually somewhat heavily unregulated, whereas stock derivatives are regulated by the SEC and other organizations. And since crypto is more of a global thing, some of it is actually kind of sketchy, and you have things like BitMEX and other derivative exchanges that aren't actually regulated. And people are globally exposed to it because people do use VPNs to actually trade where they're actually not supposed to. Well, I mean, like the rules are there to protect like U.S. customers, but a lot of U.S. customers will use a VPN or something to go around to exchanges that aren't U.S. certified, or maybe derivative exchanges that aren't U.S. certified. And a lot of those exchanges, they just basically block out U.S. IP addresses, but they really can't do anything about VPNs. They don't really try to, because the U.S. customers probably do make up a large part of their base. Same with other countries where this stuff actually isn't allowed. They just use a VPN to actually get around it, to get around the stuff, and the exchanges don't really go to them. So like once a crash actually happens to start liquidating, everyone is actually hurt, and that's why the fluctuations are so large in crypto. It's because of things like BitMEX and other like derivative exchanges that I don't actually think are actually regulated, probably including Binance. Remember, Binance derivatives aren't available in the US, but people can get around the KYC/AML, and I'm sure many people do. I personally don't use any exchange that's not US regulated, but a lot of people will use VPNs to do that stuff, and there's a lot of money riding in those markets. So when things start going up and down, they liquidate. And the fat cats and the whales actually know that, and they do take advantage of that. Like Elon Musk's statement himself, if it was only spot markets, I don't think it would have affected that much. But because of like Elon Musk, the SEC and all the other news, it's not only the stock markets. Once you play derivatives, the effects are actually multiplied several times over. And analysis shows that most of the action is going on the derivatives, which means maybe there's a few people selling on the spot market, on the exchanges, but mostly it's just like these contracts like futures and options that are really, really swinging the market and really, really dragging it down right now, because the fat cats can play these markets and they know which way the public sentiment is actually going to go. There's also a lot more manipulation that can be done in crypto derivatives because they are so unregulated. Now, just because they're regulated doesn't mean that massive fluctuations can't happen. Maybe not massive fluctuations on the entire market as a whole, like in stocks, but certain stocks like GME, AMC, obviously, even in a regulated market, derivatives can actually fluctuate the price a lot, like call options, liquidations, and stuff like that. But if the crypto derivatives market was more regulated or fully regulated, and not kind of like global, like semi not regulated for a lot of the part, I don't think it could actually affect the entire market that way. But a couple of like individual cryptos, there's really nothing stopping that even in a regulated market. So if you're wondering why it's been so volatile or why it's dropping a lot, it is because of a lot of these like options and derivatives trading right now. And ever since like CME and all that stuff and the derivatives started coming on board, crypto actually has gotten more volatile. and I don't think it's going to get any like less volatile in the time. Now that's really good for swing trading because these ups and downs come really fast. Like it goes from 60,000 down to like 30,000, but it can swing up to 70,000 at any time if the sentiment changes, and the whales can easily manipulate that sentiment to make like a price double or triple. Now there's a low end and a high end can actually go where people actually will want to take profit. And I think like 60,000 for the last time was actually that high end, but I think it'll actually go even higher next time. But once you get that higher state, and this is why it's very important to always take some profits, and you can't DCA in forever because like, you know, if you DCA in forever, your dollar cost average is always going to be kind of high. So at some point you got to stop DCAing in and then like just start taking profits as you go up. Because if you actually want to actually cash in and actually make money, that's actually what you need to do. Remember, like a lot of people have told me like, you know, you don't lose money until you sell. I hardly ever hear the opposite of that. It's like, you don't actually gain any money until you sell either. Both are actually true. So because of these massive derivative markets, mostly unregulated, and I don't think they'll ever really be regulated because once again, crypto is like a lot more global. A lot of that stuff goes on like DEXs. A lot of that stuff goes on like peer-to-peer exchanges, and you can't really just control all that stuff. I think it'll always be volatile like that, and that's why the profit taking is so important, because once you take profit, you actually lock in, and then when it goes up or down, you can just play the market yourself and buy when it's actually down, because it will eventually drop a lot. If you like DCA in and then you like dollar cost average out at a much higher price, you're going to be making money no matter what over the long term, instead of just waiting always for fluctuations. So that's what I actually have to say right now. It is actually derivatives that's actually driving us down right now, and that's really not going to stop because there's really nothing anyone can do about it, including the regulators. So that's where I am right now. Hope you enjoyed the segment and have a nice day.